Hi, I'm Dan Wilton, the CEO of First Mining Gold. First Mining is developing a couple of world-class projects in Canada, the Springpole Gold Project, which we're advancing through feasibility and environmental assessment, and the Duparquet Gold Project in Quebec.
Dan, good to see you. And I know you're in Europe at the moment. You're over at the Gold Conference in Zurich. What's the mood of the nation?
I would like to think that at $2,000 gold, we'd have a little bit more ebullience than what we're seeing. I think it's a really interesting setup that there's still, a little bit of fear and trepidation in spite of the fact that the gold price is really cooperating with what everyone's plans were. And one of the things that really strikes people here is that the larger producers, a lot of people forget this, they did most of their capital budgeting at $1,500 or $1,600 an ounce. So there is somewhere between $400 and $500 an ounce free cash flow margin coming out of producers these days that they weren't expecting to have. So they should be happier than they are.
But that's an interesting thing, right? Because if I look back to our conversations about your business model, you're building up ounces in Canada, right? That should be attractive to these guys. So what are they doing? What are they talking about? Because you're at the conference, for instance.
Yeah. So, I think what's interesting is they're starting to focus on longer term growth or longer term production profiles. And what I've noticed here sitting in a couple of these presentations is most of the producing companies are declaring victory on flat production, right? Flat is the new growth. And in a $2,000 gold environment where, I think we're all expecting, and there's lots of calls for gold to go higher than this based on where we are and sort of macro economy and the macro political situation. I think it's just highlighting the fact that there is an industry that's going to be desperate for growth. And there really is a lack of projects coming in this pipeline beyond the ones that are in construction right now. So I think it's setting up really, really well for a company like ours with big projects that we're advancing to have ready at the right time.
Well, okay, I want to talk about that in a second, but just coming back to you say flat is the new growth in the sense that it's been high inflationary environment and the cost of production has risen. But gold has also, as you say, been doing its bit. It has also been going up, and maybe net, it's kind of working for these big producers. But their intent is what? They're going to have to show growth. Like I've been speaking to some, multi-billion-dollar gold companies over the past 2-3 weeks, and they're desperate to try and tell a growth story. Where's that going to come from?
Therein lies the question, right? Therein lies the question. Most of the producers over the last 5 years have kind of shunted the hard work of development off to companies like First Mining Gold, who arguably are some of the least capable of actually advancing these projects, financially and technically. So we've done, I think, a good job of marshaling the resources toward advancing, Springpole through feasibility study process and through the environmental assessment process. But for a lot of these bigger producers, they are going to have to go buy that growth at some point in time. And some of them are taking some good credit for having looked counter-cyclically, but that's very, very rare. Most of them have been hunkered down over the last 5 years, getting their house in order, paying down debt, returning capital to shareholders, but not focused on the long term of this business, which, as we all remember, this is an extractive business. When the ounce is out of the ground, out of reserves, those reserves are gone. And you need to replace them through exploration, or you're going to need to find new projects. And so I think that's where we're starting to see the light coming on that, yes, there's some near-term growth or some near-term capital, maybe optimization, but longer term for new productive capacity is going to have to come from these companies adding new projects.
Right. And I think if I look at a company like yours, you've talked to me in the past about the kind of the cost of the ounces and the ground, as well as the amount of ounces in the ground. How do you pretty that up for these companies with the big balance sheets who can move these forwards? Because again, I'm going back to my conversations the past few weeks. You've got majors who have bought projects which don't have the licenses or permits in place. One company waiting 7 years so far for that event to happen. You've got other companies that bought into projects which have got issues around First Nations, Indigenous issues going on. So, you have to package them up a little bit further or a little bit more than previously, don't you?
Well, I think the degree to which the companies are willing to step in earlier depends a little bit on the availability of projects, right? And where they want to commit their capital, be that on something that's already been built, which, by the way, undercapitalized companies building mines usually end up not building very good mines because you end up having to cut corners to keep your budgets intact. But there are a few that have been built over the course of the last couple of years. Some of those will have to be obvious targets, but the more we advance in this sort of phase of the industry, the more likely I think bigger companies are going to look earlier stage so they can control a lot of those risks or, help to mitigate those risks themselves. So I think they will come earlier stage over the course of the next couple of years. But to your question, what do we have to do? We need to keep doing what we have been doing for 4 years, which is moving these projects forward, de-risking these projects technically, earning the social license to move these projects forward, and advancing them through permitting processes, which are not getting any shorter anywhere in the world these days.
Right. But it almost feels to me that the big guys are going to have to learn how to manage that process, because it's not something that they've had to do. They're in production. They've got a license, premises, permissions, etc. But have shown themselves in recent times to be ill-equipped to actually, stay friendly with the locals. We've seen instances in Australia and North America of that. So it'll be interesting to see how that side of their business evolves and develops. Back to you though, with the projects that you are advancing, well, obviously Spring Pole and Duparquet being the kind of key ones here, is your I think feasibility study with Spring Pole is when? Remind me.
We're really targeting the feasibility study the end of 2024, but we're probably 80% done the work that we need to do there. We're looking at potentially a pre-feasibility study update later this year, just to really update the economics of the changes in scope that we've made on the project as we've gone through the environmental assessment process.
Right. Okay. And with Duparquet, again, give us a sense of timing on that.
Duparquet, we're targeting preliminary economic assessment kind of before the end of the summer this year to give a first glimpse at what we think a development scenario might look like there.
Right. Okay. So you're kind of setting yourself up and laying out your stool. What's the competition look like? I mean, there's got to be a whole bunch of projects these majors can look at and go and find it, isn't there?
Yeah, there are. Particularly there's a group of them that have been able to attract the capital to go into construction and are being built right now. And we have an interesting slide in our corporate presentation that highlights, we right now own 2 of the top 15 development projects by size in Canada. You fast forward a couple of years and take out all of those projects that are in construction right now, some of which are really going to be finished this year, some in 2024. But there's, let's call it 5 or 6 that are rounding the corner on construction or getting to first production over the next couple of years. When our project is permitted at Spring Pole, which we're targeting environmental assessment approvals in mid-2025, which is only a couple of years away, by that time, First Mining is going to hold 2 of the 10 largest undeveloped gold projects in Canada that are really, advanced on a development path. So a lot of the other larger resource companies in good jurisdictions, and there are other companies doing good work on developing projects, continuing to grow them through exploration in around the areas where we are, in the Abitibi, around Timmins, other places in Ontario. Those projects are still going to be, I think, a few years behind us in terms of the environmental assessment process. People forget that we put Spring Pole into the EA process in 2018. So we have been at this for 5 years already, going through the EA process. Now, slowed down a little bit with COVID, mind you. But that said, it's difficult to do it much faster than what we have been doing. So this is going to be one of the next projects that's permitted in the province of Ontario, one of the next major mining projects. So, yeah, I think it leaves us at a really interesting position that there's going to be very, very few projects sort of permitted, ready to build in that 2025 to 2028 timeframe.
Okay, so scarcity is your friend, and scarcity usually does one thing and one thing only to price. The other component in this mix is, and I don't know what you've been hearing at the conference with regards to people's forecasting of gold price. Now, I think 3 years ago, some of the calls for $3,000 gold was probably a little bit premature. Let's put it that way. But since then, we've been printing money for fun. The economies globally have a little bit exhausted, a little bit tired. Inflation has hit people hard, and money seems worth less. So, what are you hearing with regards to gold price, gold forecast at the conference?
No, I think some of the best forecasters of gold price in the world are here, and we have the ability to kind of pick their brains and understand their level of excitement. One of the preeminent forecasters has just gone what he calls max bullish, and this is a guy who has does some of the best work in the world on forecasting gold prices. So he's forecasting 2,500 by the end of the year, which he is calling a slam dunk, and thinks that there could be real upside momentum from there, really based on, ground up fundamental value analysis and looking at what's going on sort of in the macroeconomic and macro political climate in the world. What a lot of people forget when you just start figuring out what the cost of servicing the debt is in the U.S. at a higher interest rate like we're at now, it adds trillions to the annual deficit. And there was a time when $1 billion deficit in the U.S. was something that was extraordinary. Like, you remember global financial crisis, 2008 and in 2009, the U.S. ran $1 trillion deficit. Extraordinary times. They needed to save the global economy. Well, the $1 trillion deficit today is like, that's a throwaway. That's a given. And that's servicing this debt at a much lower interest rate. Like, you look at what's happening now with interest rates, they can't afford to be able to have rates high for all that long. So, or if they do, then they're going to have to find another way to continue to service that. And ultimately that looks like, I think, printing money, which is, again, this long coordinated global race to the bottom.
Yeah, I know. We've actually just put out a report ourselves with we think gold and gold companies as a proxy to the gold price this year for producers should be a big year, and that cascades down for sure into developers and explorers. So I'm fascinated by what gold price will do this year. More than any other time previously. Now, just with regards to you've described some of the things that you're going through, the phases that you're going through. Needs funding. You've told me in the past you've got a lot of money, but you've also just offloaded some non-core royalty portfolio projects. Why now?
I think that was a way that we could continue to get the money that we need to advance the projects that we're working on. Without diluting shareholders, right? And that was really the benefit and the power of this portfolio of assets that we have in First Mining. It's a lot of work to turn some of those assets to account and turn them into cash to be able to fund. But, we sold in two different transactions, sold these royalties, which were all royalties that we created mostly on selling or partnering out other assets for almost 17 million Canadian. So, not bad for something we were getting no value for in our share price and, was kind of sitting in the cupboard. We still have a bunch of those other types of assets, a marketable security portfolio that's now $13 or $14 million. We've got, the project interests in Pickle Crow and Hope Brook that are major projects being moved forward by our partners doing great work. And we have carried interest positions in these projects that we don't have to fund them. And our project interests kind of stay at that 20-30% level. So, I think we've got a lot still in the company that gives us some financial flexibility. We got to work hard, again, to turn some of those things to account. But lots of flexibility in what we have today.
Right. And so obviously there's the kind of the royalty component, and there's also stock component to this as well. I guess in this market, the stock looks less interesting in terms of offloading. I'm sure the stock, the companies with the stock would want to have a conversation with you about when and how.
Yeah, naturally. But, as we always say, the only thing we'd like to do less than selling some of our marketable securities is having to sell First Mining stock at, $6 an ounce in the ground or, 0.1 times our fundamental value. So, you sometimes have to make hard choices. But I think the other flip side to that is in a robust market, increasing gold price, when we start seeing some, interest start coming down into the development sector, these marketable securities could be worth, 3 to 5 times what they are now. And those start getting to be really meaningful numbers.
Right. Okay. Just I always like speaking to people when at conferences. So conversations, you've had some good conversations, some good meetings, I'm sure. But what's your kind of key takeaway from the session?
Key takeaway for us, we managed to connect with a bunch of existing investors here, a few new investors. And I think we've had great support from our investors who are looking at our current share price, which is at or near all-time lows, as a real opportunity to add to positions. I think one of the things that we're walking away from this conference is there is a real recognition amongst investors that if you are a value investor, and that's my whole career, I've very much been a value-focused investor, the development sector is the deep value sector in mining right now. You are buying dollars for 5 cents. And the downside risk when you're doing that is actually, I think most people think, pretty limited, particularly in an increasing gold price environment, in an environment where you can very clearly see how the M&A market is going to start increasing in activity. And you have producers who need projects who are starting to generate lots of free cash flow, more than they were expecting in some cases, a lot more than they were expecting this year with a higher gold price. So all of those factors come in to say, this is a really, really good time for people looking at deep value investing to be looking at gold developers, and First Mining Gold particularly.